What if I told you one of the most popular trading strategies today, smart money concepts, might actually be a modern ripoff of the classic Wyckoff Method? Today, we're diving deep to uncover the truth and backtest both strategies 100 times to find out which one really delivers results. In this video, we'll break down the similarities between SMC and Wyckoff, and then reveal how one is secretly based on the other, and most importantly, test them side by side to see which one actually performs better. Trust me, you'll want to stick around for the results. They might just change how you trade forever. SMC has exploded in popularity lately, with traders claiming it's the secret to trading like institutions. When you break it down, SMC is packed with concepts like liquidity grabs, order blocks, and market structure shifts that look suspiciously like ideas from the Wyckoff Method, a strategy that's been around for decades. Now the question is, did SMC really revolutionize trading, or did it just repackage Wyckoff's principles with a fancy new name? And more importantly, which one actually works better in today's markets? Let's start with the Wyckoff Method. This strategy focuses on understanding market cycles, accumulation, markup, distribution, and markdown. It's all trying to attempt to identify what the big players, banks and institutions, are doing and following their lead. Exactly like SMC, which is all about understanding how institutions manipulate liquidity zones to execute their trades. Now, here's where it gets interesting. Look at how similar these two setups are. A Wyckoff spring, where price dips below support to trap sellers, is almost identical to an SMC liquidity grab, where price sweeps a key level to trigger stop losses before reversing. Make sure to stick around until the end of the video, because I'm going to be showing you guys a comparison between the two backtests that I think will actually shock you. For the sake of this backtesting, I'm going to simplify this a little bit, because if not, it's going to be really hard to backtest this properly. We'd have to use replay charts and it would take hours and hours and hours and hours. I just don't have time for that. But so what I'm going to do to simplify this, and it makes it easier for you guys to actually follow, is I'm going to use the Wyckoff phase oscillator and the chop and explode. The reason for this is because the whole idea of the Wyckoff method is to avoid accumulation zones, which are basically choppiness zones, and to trade breakouts. So what the Wyckoff phases oscillator does is it basically tells us whether we're in an accumulation zone or whether price is going to break out and start trending. So we're going to be following this, green meaning we're going to go long, and red meaning we're going to go short. Also, for the sake of this backtesting, to speed it up a little bit, I'm going to take a 1.5 to 1 risk to reward ratio. That way I can have fixed take profit and stop loss levels that are just a bit easier to follow. And we're going to start at the very beginning of 2024 so that we can backtest the exact same period for the SMC method. Took a shot of success, hit nothing but net. Alright, now if we take a look at Trader Edge, as we can see, after 50 trades, we had a 20% profit, 48% win rate, and that was on a 1.5 to 1 reward to risk. As you guys can see, our drawdown was really low, and overall, all the metrics on Trader Edge are green. Even the edge score is pretty good. For the SMC method, what we're going to do is super simple. We're going to use fair value gaps, and I'm going to use the Lux Algo fair value gap indicator. So if you just look up fair value gap and choose the Lux Algo one. Now, I changed the settings to set the threshold percentage to auto. That's the only thing I changed. So for this, I'm going to be using replay bars, so you wouldn't be able to see all the fair value gaps. But in theory, how this actually works, let's find a good example. This fair value gap was formed up here, price moved away from it, and then came back in. We would have had a order set here, maybe a stop loss somewhere over here, and then I would have moved my take profit, set it to 1.5, and then we would have gotten filled in here and take profit down there. Diamonds in my teeth, I got a lot of shine. Running up the number, that's a lot of crime. Try to take it from me, must be out your mind. Lot of sun, smoky in the air. Alright, now on Trader Edge, something cool we can do is actually select both of these and come up here to compare. As we can see, the results are honestly pretty similar. I think the Wyckoff method in this particular backtest did better, but honestly overall, I don't think there's actually a huge statistical difference between the two. I think the only real difference is either just that specific time period that we tested, because we only took 50 trades on each, 100 trades total. Overall, I'd say these were actually pretty similar results. Ultimately, I don't really think it's the strategy, but more so how you execute it that matters the most. Look, I'm not an expert on either of these two strategies, but what I can tell you for sure is that both of these strategies will work. Just pick one, stick to it, practice it like crazy, and don't quit. I'd like to know in the comments, which one do you guys think works better, and which strategy do you guys use? Also, if you guys want to backtest these yourselves, I've linked Trader Edge below. It's the exact tool I use for all this backtesting, and if you want, there's also the link to the actual strategy that I use every single day when I trade. I hope you enjoyed this video, and I'll see you in the next one.